All right. Hello, my name is Ralph Mims. I'm the Economic Development Manager for the Village of Los Lunas. And this is our first annual Valencia County Commercial Lending Summit. And this is the idea that basically Dave and I and Valencia Chamber came up with as a way to get the bankers out to the community so they can let small businesses and established businesses know what type of programs are out there as far as lending, banking programs, lending capacity here in the America area, Valencia County, and in Los Lunas and surrounding areas. So we're glad that everyone is here, and this is a great forum for this. And this event is sponsored by the Small Business Development Center, the Village of Los Lunas, and the Valencia County Chamber. And we're just glad that we're putting this on. If it's successful, we'll have another one next year, and we'll get you guys more engaged in the community. I know you are, but this is a lot of good information that you could convey to the community. Without further ado, I may want to go around the room. Can you guys just introduce yourselves real quick? Just say who you are and where you're from.
I'm David Blatcher. I'm the president of the Greater Berlin Economic Development Corporation. I own a shopping center in Berlin, and I'm from Albuquerque.
My name's Tom Sanderson.
I'm Barbara Russo, and I live here in Los Lunas and just getting my business started.
I'm Tom.
Yeah, Tom.
Almost where we were last.
No,
Tom Greer. I'm on the executive committee of the Greater Berlin Chamber of Commerce and the vice president of the Berlin, New Mexico Main Street Partnership, historic preservation organization, and the owner of what used to be a good idea, a lot of property in Berlin.
I couldn't do it.
Diana Croson with the Village of Los Lunas.
Oh, there you go.
I'm Aaron Romero. I'm with Century Bank in Albuquerque. I'm also from the area, own a small business as well.
My name is Wayne Chandler with BBVA Compass out of downtown Albuquerque. I'm an Arizona Wildcat. I'm from Tucson, Arizona.
Hello everyone, I'm Steve Morgan, recently returned to New Mexico. Formerly I was the executive director of a 110,000 member health plan in West Texas. I have started up my own health insurance business and consulting firm. Have a few clients, like to grow. I owned a business before when I lived in New Mexico, and I had about 23 employees then, and did a lot of work for Loveless. It's good to be home, and look forward to learning something today. I don't plan to remain a one-man business very long.
Terry Wagoner, business owner.
My name is Jim Glover. I'm the founding partner of the Idea Group out of Santa Fe, and we do a lot of strategic branding throughout the state, and we're currently working with Los Lunas on its community branding.
Great. I'd like to hand it over to Dave Carlberg. Dave Carlberg is with the Small Business Development Center. So Dave, why don't you take it away?
All right, thank you. Thank you. I'm a business advisor out at the SBDC, Small Business Development Center, and this is an important concept that we want to try and promote throughout Valencia County. Because we feel that there's a lot of things that we need to have happen, and a lot of it is going to go through obviously banks and commercial lending. So the more we know about what they need, the more successful we're going to be. Now today, we're trying something new here for us, a panel discussion of what is involved with commercial lending. And we're going to start from an idea that is broad. In other words, what is the economy? What can we expect from the economy, perhaps on the national level or from the local level? Now, I'm not sure if you all know, we are going to have an election here in a few days. Yeah, it's been on TV and that sort of thing. What's TV? Attaboy, Dave, right on top. And what we don't want this and to be misinterpreted as any kind of a promotion one way or the other for any either Republican or Democratic ideas about what the future holds. But one thing that we can kind of expect from any new administration or existing administration is probably more of what we've had this past year, particularly, perhaps with a dose of a little more intrigue or a little more downturn in some areas of the economy. One of the things I want to do before we go any further is to just start and have each of you introduce yourselves, give us a little background about who you are, who you're with, and what you do, that sort of thing. Why don't we start here?
I'm Roy Archuleta. I'm with my bank, formerly Bank of Belen, operating primarily out of Valencia County. We're a small community bank with only 5 branches, one here in Los Lunas, 2 in Belen, one in Mountain Air, and one up in Albuquerque. I'm what you call an all-purpose lender there. I'll do everything from a small consumer loan to $1 million line of credit, commercial loans. Happy to be here. Thanks.
I'm Doug Branham. I'm with Sandy Laboratory Federal Credit Union. We're actually located out here as well, but we have like 7 branches in the Albuquerque area. We're a pretty large credit union. We're about 1.7 billion now. We've been now doing commercial loans for about the past 5 years. You see, my background is I've actually now been with the credit union for the last 5 years. I'm pretty much a generalist as well. I do everything from credit card loans of $5,000 up to I did a healthcare facility in Albuquerque for $4 million. So we kind of run all the way from servicing the smallest businesses in the community all the way up to at least mid-sized businesses. I think our range is somewhere from like I say, the small businesses, whatever they require. I mean, I do revolving lines that are 15, 20,000, but we have done loans up to about 10 million. So anyway, and my background is I've been doing this now for close to 20 years. Like I say, the last 5 with the credit union. Prior to that, in my other life, I actually worked with Jacob at a bank called First Community. I think that's right. I'm kidding. Which is now U.S. Bank. And there I was actually a residential construction lender. So quite a change. But residential construction lending, unfortunately, like a lot of other things, fell off dramatically in 2007, 2008. So anyway.
My name is Ed Vitamontes. I'm with Wells Fargo Bank. I am based here in Valencia County, but I also report downtown to downtown Albuquerque. I've been with my organization now for 18 years. Been in banking over 23 years. I am strictly a commercial lender. I can lend to all sorts of businesses, whether it be sole proprietorships or large corporations.
I'm Kathy Sorensen. I'm with the Loan Fund. We're a nonprofit CDFI, Community Development Financial Institution. I venture to say we're probably the only CDFI that is housed in a former convent. And really careful.
Does that help?
But anyway, we are a commercial lender. That's my background. I'm a senior lender with the Loan Fund. And we make loans anywhere from $5,000 to $750,000, so we have a nice wide range there. We typically, well, I would say our borrowers are typically not able to access bank credit for any number of reasons, so we're here to try to fill that niche. And we've been around for 24 years. And one last thing, I think it was 2011, we received the SBA National Award for access to capital.
Good afternoon. I'm Lorena Lucero.
U.S. Bank came in January of 2011. We were formerly First Community Bank. So I'm sure you saw in the news, FDIC did take us over. And in the transition, U.S. Bank purchased First Community Bank. And that's a whole other summit on that, so we won't go into that. But anyhow, I am the branch manager there, and I do consumer and small business lending.
And I'm Jacob Arbico, and I work with Lorena at U.S. Bank, and I was part of the First Community Bank team as well. I've been in banking, it was 23 years in May, so seen a little bit come and go over the years, and it's been interesting. She covered a lot of the U.S. Bank stuff, but part of the reason that we're here together is because even though I'm considered the market president for the South Valley, Valencia County region, and Torrance County region, which means I have kind of the 30,000-foot view of the lending process, but also the business development. And within our organization, we're all really considered bankers. I'm not the lender, and she's not the branch manager per se. At the end of the day, we're bankers, and our strategy is with our customers to approach it from a banker standpoint, not, well, you got to go see the loan officer, you got to see this for that. We really try to custom tailor everything to fit our customers, regardless of what they need. So that's why we're here, because I do primarily the commercial stuff, but I also do business development, setting up checking accounts for small businesses. My neighbor across the street, I try to get him to come bank with me in his personal loans or in his personal checking account. So that's what our role is within the organization, and we work together pretty closely. I have 4 branches that reside within our territory, which is in the South Valley, Los Lunas, Belen. We have a branch in Moriarty. We have another RM or commercial lender out in the Moriarty region. It's really just 2 of us running a pretty big portfolio. So.
Well qualified, all able to speak on our level, huh? What a relief. Well, thank you. That's great. How we want to proceed on this, we've got some questions already formulated that we're going to toss out and get the ball rolling. And we want you to feel very comfortable in raising your hand and asking some questions. In order to control what those questions are at what time, though, we're going to start like from the 30,000 foot view, like I mentioned a minute ago about the economy. And then we're going to come down into what is expected as from a potential borrower, what are the loan terms and that sort of thing. But if you have any reluctance, and you should, we're all friends and neighbors here, by the way, raise your hand as we go through. If you have a question, we'll recognize that. If you feel uncomfortable doing that, I happen to have some 3x5 cards that you can write your question down, and we'll get it up here, and I can read it and go from there. So whatever you feel most comfortable with. Well, let's start this afternoon with that that question about, and I preface it by saying the economy here in Valencia County is what we really want to focus on for the upcoming year. What could potential borrowers, or what are we looking at as far as the economy in Valencia County? Anybody here to start the ball rolling on that?
Well, I think what holds for the county, you're going to see pockets starting to emerge with a little bit more activity. By no means do I think that we're going to see a lot of activity. I think we're going to continue to see slow growth. But I think other pockets of the county, I am based in Belen, so I have a front row seat as far as what's going on in that market. Continue to maybe lag behind. I have seen some greater activity in the Los Lunas market, and I think Los Lunas, just by where it strategically is located, has more opportunities than some of the other towns within the county.
Other comments?
What I think what's going to be interesting to look at next year specifically is, especially with I think it's a 60-day session coming up for the state legislature this year, and I'm interested to see what happens with the capital spending, capital outlay budget specifically next year, because I think that drives a big portion of our economy, especially in Valencia County with a lot of our small business owners. And if that's scaled back, which I think our gut feeling is that it's probably going to be from a true budget standpoint, I think that could have some negative impact on some of the smaller businesses. But on the flip side is, if we can at least maintain a good level of that type of activity, it helps in many aspects of grocery receipts, and not to mention, a lot of our municipalities really try to prefer to use local contractors, local subs whenever possible. So I'm going to be real interested to see what occurs with the legislative session next year, specifically in the state of New Mexico, and see how the oil and gas royalties are affecting this. We know those are up the last 12 months, so let's see what happens with those, and I'd be interested to see what happens with that. I think if we're lucky, we should be able to maintain at least that level of spending.
How would we be able to tell? In other words, you said, well, it depends on what happens in the legislature. How are we able to read the paper and say, oh, I remember what that guy said? What does that mean? What does the legislature have to do to affect Valencia County's welfare?
Well, it's going to have, the first and foremost, what I think is going to, the biggest, does anybody know what the single largest employer in Belen is? Does anybody know? Schools. Schools is the single largest employer in Belen. And so if they cut back on the SCG, the state equalization guaranteed payments for a specific number of students, that's definitely going to affect the economy in Belen and Los Lunas, because Los Lunas School District is, believe it or not, nearly twice the size of Belen. Their budget is nearly twice the size of Belen. So I look at those as very good indicators for us on how we'll see the economy going at a local level, because those are two big employers that really drive our economy. The other thing we're going to see is what kind of pork bills come out of the state senate next year as far as bringing money home for capital outlay projects. If we see some good projects coming through, it could be a new field house for Valencia High School. I don't know what that is, and please don't, if they're good on paper, don't say they're going to put a field house in Valencia High School. But those are projects that I look for, and capital outlay projects that I like to see come into our economy, because it not only drives the small businesses, it brings in grocery receipts, it keeps people working, it creates economy, it creates, when developers come and look at our area, they're going to see buildings going up, they're going to see new school buildings going up. Los Lunas School is basically rebuilding the entire Los Lunas High School. That's not a result of a capital outlay project, that was a result of a bond issue. But look for bond issues coming about, and you got to make sure and look at those bond issues and see what they're for, and see how they're going to affect our taxes, and see how they're going to affect our economy, because those are what I like to see as a banker in my economy. Those drive our economy. Public funds, believe it or not, drive a big portion of what we see in our local economy.
Thank you.
Yeah, I would just second what he said there. I mean, and I'm located on the west side of Albuquerque, so, and eventually I'm going to be on the Rio Ranch. I'm by the Cottonwood Mall right now. But just like Jacob said, when you look around at Albuquerque as a whole, what's going on there as far as construction goes, it's anemic. And especially on the private sector side, it is really anemic. And I can tell you one of the factors there is that, I've seen some projects come through lately where, the last one I saw is a guy who's looking to build an office building. Well, the problem right now is there's a dynamic going on in Albuquerque that the appraised value of that new building can actually come in less than the cost to build it. Well, that just doesn't make any sense. So who's going to build? And it all factors in with the vacancy factors, things like that. But we're, as lenders, we're bound by that appraisal. What we can lend out, which means that the borrower will have to come up with more money. But getting back to his point about what capital outlay projects there are, most of the building going on in this state right now is being funded by the public sector. So that's a critical issue. And where all that goes, and especially in Albuquerque, I mean, I can tell you, I mean, the belief there is, at least what you hear, is that approximately a third of all the jobs in the Albuquerque area are tied to the labs. A third. So you have people that are directly paid there, you have subcontractors, and then you have people that bring in the ancillary things to the labs. I mean, and if there's any kind of major cutback, I mean, that's why our economies here kind of go along, as opposed to like in California where they've just gone off the ledge essentially. We've been able to maintain, because so much of our economy is driven by the federal government or the state government. We've at least at least in the Albuquerque area, home prices where they've fallen to some extent, haven't fallen as far as what you've seen in places like California because of the federal government. But having said that, I mean, I really don't want to address the national outlook because I just don't know what whoever's going to get elected is going to have in mind for either military spending for the labs, things like that. But I can tell you, if it's cut back, it would be very detrimental.
Dave, can I ask a question? I think it's really a great comment. A lot of the advertisement going on next to this election that's coming up is that we're going to lose 20,000 jobs in Albuquerque, basically, and most of it related to the government. Are banks preparing for something like that, or do you believe it? I mean, that would have to have a hell of an effect on the banks if 20,000 people lost their jobs.
I think what they're referencing there is this fiscal cliff that's coming up, and that there would be a 10% cut across the board. So that would mean for every federal agency, you're going to have a 10% cut. That in Albuquerque would essentially take 20,000 jobs away almost immediately. My personal belief is that we saw what happened with the budget ceiling. That whoever gets elected is going to address that right away and at least kick the can down the road. Now, if it does happen at some point in time, I think that the effect would be pretty detrimental for the Albuquerque area and all the surrounding areas as well. But honestly, this is just my personal opinion. I don't think that's going to happen. I really don't. I think these guys set this up not thinking that this was something that was actually going to come to fruition. So,
not to move this off this. Literally, this type of conversation could go on for another hour, and I think all of us would just be riveted. But anybody have any other comment about the local economy, where you think it might be headed at this?
Just really quickly, getting back to the small business person, I think it's going to continue to be somewhat sluggish and kind of herky-jerky kind of thing going on there. And I think what's still happening is businesses and individuals are still deleveraging, which means reducing their debt. And until that happens, and it continues to happen, it's hard to get a business loan if you want to hire people or buy new equipment or have working capital. So there's going to be some deleveraging that still needs, this is built up for how many years? So, but having said that, I still feel optimistic that if someone has a very unique product or service, this could be the best time to start that business. So, but you've got to have something that's very unique. But there are opportunities out there. So you just have to find them, and so I have some optimism about that.
Based on what you just said, people starting up with unique ideas, in my experience, from a banker's perspective, are significantly a big risk. So how are you folks prepared to look at startups and evaluate legitimate risk, including things like sweat equity and so on? From a banker's perspective, how do you value sweat equity?
This is a perfect segue, wouldn't you say, into our next level of questioning. I mean, you've just brought us down from 30,000 feet down to maybe 20,000 feet.
My parachute works.
There you go. What do you consider to be, let's go into that right now. What do you consider to be the most important factors when considering a loan to a small business? Let's start there and then we'll go further down into that. Who wants to jump onto that?
For an existing small business, us as bankers, we look at everything. We look at what type of products and services can we bring to the table for this customer. What are they going to bring as far as products into our bank, and how can we not only help the customer, but at the same time generate income for our employer, because at the end of the day we need to do that as well. But right, if you want to know what it's going to be across the board. Number one for an existing business is going to be cash flow. Cash flow, cash flow, cash flow. Collateral, Doug said something, or was it, yeah, Doug said about the building that appraised for less than the cost of it. So collateral is not as big of an issue as you would have seen in the last 6 to 7 years. It's going to be cash flow. It's going to be character and credit. It's going to be those C's of credit that we look for. And so that's what we're going to be looking for in an existing business. We are going to look at, what type of products and services can you bring to the bank so that we can price your loan or your products competitively and make it worth your while to do business with us. Because the last thing I want to do is put a product on the books that's not profitable for the customer and certainly not profitable for the bank. That's not what I want to do. So we look at it and say, okay, the person's going to bring over their checking, their savings, their credit cards, their merchant processing, treasury management services. One of the products that we look at, their small loan, their lines of credit, their term loan for their equipment, all these things. That's what we're going to look at least from our aspect. And we're going to see how can we help this customer and what do they bring to the table as far as being able to be a good, solid customer that we can help and also it's going to produce income for the bank.
I think another thing that we take into consideration is the type of industry that the business is operating in. As we all know, certain industries have really been hit hard by the economic downturn, construction specifically. And many people have been able to weather the storm based upon the way that they, based on their balance sheet, the amount of leverage maybe they were carrying on their balance sheet. If they were relatively low leverage, they could absorb the lesser revenues. So industry is also something that we look at. We don't discount any industries other than a few that banks prefer not to deal with. But for the legitimate business owner, that's something that we do take into consideration, and we try to mitigate those risks.
I would just add, Jacobs, any conventional lender, which most of us are up here except for Kathy, we are cash flow lenders. That's what we're talking day one, that we have to establish cash flow with the business. And on the conventional lending side, which what I mean by that is that when we do a loan in-house, when I just do it through the credit union, we're rating risk. And what we're always looking at is basically your ability to pay us back. And when you have a startup business, it's very difficult to assess that risk. That a lot of startups obviously go under. So on the conventional side, usually what we're looking at is businesses that have already been established for at least a couple of years and have established cash flow. But having said that, and then we don't have anybody from the SBA here, just from the SBDC. So Dave from the SBDC, I use a couple guys in Albuquerque who are Ted Trujillo and Steve Becerra.
Sure.
And basically, they're kind of, you guys are kind of liaisons to the SBA. So, and what the SBA does is they have a program that I think everybody here is involved with. It's called the 7A program. And what the 7A program allows a small business to do, even somewhat of a startup business, is to show how they're going to establish cash flow. And then the collateral issue isn't such a big issue because basically the government guarantees the loan. And that's why when somebody starts talking about, well, we could potentially take this to the SBA, that's what they're talking about, is that you don't have, a strong enough collateral position to move this forward, but potentially you have the cash flow to do it. And then you step in and you work with Dave. Dave would help you. What I always do with startups when they're just starting up is tell them to go to somebody like Dave, because he'll help them put a business plan together, he'll help them do projections. All those things are critical for me to see and then assess what's going on and then see if it's something that I can present to the SBA. So that's kind of the way we get around the collateral issue, but the cash flow issue, that at the end of the day, that's what all of us are doing up here. I mean, if we can't establish a cash flow, we can't do your loan.
You mentioned a term that we've all heard over many years in banking, and you're a well-seasoned person, and I'm sure you value sweat equity in what you put into your business. You value and you take to heart. Unfortunately, over the last few years, we've seen many people that they'll put the sweat equity in, but they don't care about it at the end of the day. So bankers have discounted that to a certain degree, to more of a degree than they probably would have in years past. Simply because people are more willing to walk away from their sweat equity than they probably were 10, 15, 20, 30, 40, 50 years ago. At least in my opinion. That's what I've seen. You know, I know that you obviously must value your sweat equity because you take pride in that. And that's certainly something to be commended. Unfortunately, it's not all that it's cracked up to be these days, unfortunately, because people will walk from that sweat equity in 2 seconds, say, you know what, I'm going to cash into it, it's just my time. I'm done.
What I would add to that is that I think as an emerging business, what you definitely want to focus on is presenting your idea to the bank in its best possible light. A lot of people have the misconception that basically they wake up in the morning and they have a fantastic idea, they have a product or something unique to the marketplace that people just can't do without. They walk into a bank, they present their idea to the banker, and we write a check for it. You know, it's a very common misconception, but what we look for, and what he was referring to earlier is critical, is a business plan. You know, we need a well thought out, in-depth analysis. I mean, we have to do our due diligence in analyzing the industry or the conditions for your current business to take off the way that you say it to, the way you say that it will. But essentially, you know, we look for things, like he was saying, pro formas, revenue projections, the cost of maintaining the business, and at the end of the day, cash flow. You know, the money left over after your operating expenses that will repay the loan. You know, there are a lot of ways that we can tailor a loan for an emerging business, even with regards to interest-only payments at the beginning until, you know, more of a profit footing, you know, takes place within a business. But we look for, you know, market analysis. We need to know that you research the competitors in that business, identify, you know, possible adverse conditions that could present themselves, and how you, as a business operator, would react to those, as opposed to, you know, completely, you know, giving up or exiting the business. The characteristics of lending, you know, they haven't changed. You know, the 5 C's of credit, the capacity, the character, you know, good creditworthiness. Collateral is a very important part of that. What the bank wants to see on behalf of the lender is we want to see on behalf of the borrower is that you also have some skin in the game. You know, basically, you know, it can be all of our funds at work with the hope that the business takes off the way that you expect it to. Now, there are different forms of collateral that can be assessed, but that inherent risk that's shared by the business owner is important to us because it serves as both motivation for the business owner to continue on in their endeavors with their idea, and it also serves as a deterrent for them. If they've got equity injected into a project, if they've got $10,000 or $20,000 for a piece of land or a building that's committed as collateral to their project, they're less likely to give up when tough times might set in, you know, when it comes to their particular industry.
Well, you all are singing my song up here as far as business plans are concerned, and I appreciate that. Let me take just a quick minute to give a commercial about the SBDC and what we do. I can't help it. What we do is talk to new and existing businessmen and women about, for instance, the new businessman that has that idea, that has that enthusiasm. Boy, I can fix this better than anybody. I can fix cars or bake bread or do whatever that one single unit of labor can do. And so therefore, that person thinks this is the best thing. I need to go into business for myself. What we do is come along and we say, okay, how are you going to handle these things? And we have a checklist which I have shared with Kathy, that leads to the creation of a business plan. So it's a very step-by-step process. And what happens is we don't discourage anybody in any way for attempting or starting off in their own business. What we do is present different alternatives that say, have you thought about this? Have you thought about this? What happens if? And that goes to what you were saying. You know, changes in the economic environment, changes in the competitive environment. What sort of research should be done? Research is never mentioned, basically, for new people coming in anymore. How many restaurants are there in our area? How many happen to be oriented towards Mexican food as opposed to something else? My point is that that's one of the things that we do, and we do rather well, I think, is to counsel with folks that for startup businesses and existing businesses to fix perhaps that part of their business that doesn't work like it used to. And they're wondering how that happens. And so thank you for bringing that up. And I appreciate that. I think what we can do now is get down into, we've touched on the 7A program and perhaps a couple other programs that maybe SBA would be interested in promoting through your banks, through your institutions, that sort of thing. What types of programs, let's get down into it if you don't mind. What kind of programs do you have available that a existing business might be interested in, or you know, that you are able to offer to a startup in under some conditions? Any particular, as you mentioned, I think the waiver of principal payments for the first 90 days or something such like that. Is that, you know, that sort of program? You want to elaborate on that?
Well, I think that, you know, especially as an emerging business, as a startup, you know, you're probably not going to see, you know, much profit right off the bat, depending on, you know, how cost intensive your operating expenses are. But yeah, I mean, I think that's one of the things that we do best as a community bank, is that we're able to tailor our products a little bit more uniquely to the individual requests that we have. It makes sense to me just the way that you're building a home, for example. During the construction process, we only pay interest-only payments on the outstanding balance while you're building, you know, in anticipation of getting that larger takeout loan. But I guess that same principle should apply with regards to an emerging business until, you know, you're a little bit more established and the revenue is stabilized enough for you to be able to start reducing, you know, the principal balance of the loan. But yeah, I think as a community bank, we're able to tailor our products quite a bit more. I mean, every loan, no two loans are the same. And I think that we act pretty well, and we have some good insight in our lending staff on how to tailor this product.
I want to apologize. I called you Dad. Oh, forgive me. Forgive me for doing that. Anybody else that wants to reflect on some specific programs that you might have that might fall out of the 7A kind of category?
Well, I think, you know, finding out what's important for the business owner. I mean, what's important to them. Oftentimes I meet with people, and having a fully amortized fixed rate note is very important, not having that interest rate risk of having a balloon note come up 7 years down the road, 8 years down the road, not knowing what your interest rate is going to be at that time. And so in determining what's really important to the business owner, in a scenario like that, maybe offering options as far as how you can structure the financing, specifically with a 7A note. Oftentimes, if we're dealing with a real estate transaction, we can do a fully amortized fixed rate note up to 20, 25 years. And that gives that business owner the comfort of knowing that this is going to be my payment for the term of the loan, instead of having that uncertainty of what's it going to reprice at when it does come up for maturity?
And along those lines, sitting down and talking to the customer and listening to what they want, and it's really understanding what other products and services are out there, not necessarily under the same roof, but what's out there to help that customer so that you're not just acting as their lender, you're acting as their banker. And so we go back and we say, well, you know what, we just can't qualify this under current bank guidelines, but I have these great people at the loan fund and I really want to get you set up with them. And I think too many bankers just automatically say, oh, startup, no, thank you, we don't look at those. Right? We don't look at those. Well, once again, what did I say? I want the checking, I want the savings, I want the credit card processing, I want all that other stuff that can go along with this startup business. So I don't think bankers are doing a real good job of making sure that they listen to the customers and get them to the right place. I mean, and the loan fund isn't the only avenue. There's 3 or 4 other organizations here within our community that exist that are very, very substantial in our community that have provided a lot of funds for startups so that ultimately they can get to the point where they're bankable and to where they can get to the point where we can do a traditional 15-year fully amortizing note at a fixed rate for that customer. That's what I try to look at and try to figure out how we can help them at that point.
Anybody got some comments? Go ahead.
I want to talk about established businesses for a second. And 3 of these guys up at this table, I guess when I said guys, it automatically leaves these 2 out, have almost all of my business. But I have an interesting situation, and we talk about equity, and we talk about willingness to stick with things. We took advantage, my wife and I did, in 2004 and 2005 of the stated income, no money down, buy anything you want programs. We bought 14 townhomes on the Tierra del Sol golf course. We have over 800 credit scores. We've never been late on a payment. We now have a 7-year history of perfect payments on those houses. 6 of them are at 10 to 12% interest. And because insurance has gone up, tenants' income has gone down, property taxes have gone up, our margins have shrunk like this. We have 80% equity in these houses, but in the current lending environment, we have 0 because they only, we have 20% equity. They only will lend on 80% of it. So we go to the bank that has these, who's getting 10 and 12% interest with perfect payment history. And the basic response to it is, why would we want to refinance you? Because first, our assets and liabilities have come, our asset to liabilities are now out of whack. But if we were refinanced at 6 or 8%, all of a sudden that number would be correct again. And the answer simply was, well, in order to get refinanced, you need to be 180 days behind, which is rewarding bad behavior. Now, we didn't have any money in these. I mean, we had some, we did closing costs in these things. But we have stuck out and had perfect payment history on these, providing housing for about 70 people who probably couldn't afford housing and certainly can't buy a house in this environment, in nice houses and these things. And we have stuck out with a perfect track record, 7 years of the hardest times in the residential real estate business in our lifetime. And we can't find a way to refinance these houses to get our margins back into whack, to be able to give me enough expendable income that I have a sizable chunk to put down on one of 2 really neat new energy-related businesses that we would like to start up here, where we would actually have some equity capital to be able to spend on it, because we wouldn't be paying at all in interest on these other houses. It'd be interesting just to have the comments on that. I do have to say something for the guy on the end down here, because community banking is one of my favorite things. And we own the Rail Cafe property at the railway interstation, which has been in this economy of the dollar meal, at McDonald's, and all these other things, a difficult piece to keep a hold of. And we have continually worked with the bank and reworking the pieces and everything. So I just wanted to give a little kudos to the guys who helped me keep that. I mean, my concept of moving ahead in this economy is just hanging on to what you've got. It's okay. But we would have a lot more ability to employ people, to invest in other property and ideas and stuff, if I could renegotiate some of these loans.
Let's hear from the masters over here.
Well, I think the residential mortgage lending, their guidelines they're somewhat convoluted.
They're horrible.
They're terrible. Yeah. I mean, I've heard everything that you mentioned. I've heard it's happened, and it's happened within my organization also. Mm-hmm. So we're not exempt from it. I think I must differentiate from a commercial lending point of view mm-hmm. versus the mortgage lending perspective, night and day. Because again, from a commercial perspective, things that we've mentioned before, we're looking at cash flow.
We'd love to get them over to commercial, but nobody will talk to us about it.
The reason for that, if it's 1 to 4 unit residential property, typically a commercial lender, their hands are tied because of disclosures that have to be provided by law. And so as a result, it's limited to that residential mortgage channel, financing channel. And again, why they've made it so convoluted, and I've heard that they're telling people to go delinquent in order so that way they can restructure mm-hmm. the loan. What sense does that make?
Well, they tell you that you'll lose your credit score, and I go, I've got an 840 credit score, and I can't buy anything. What in the world is it worth? Okay, so it comes down to only my morals and ethics that say I'm not going to walk in and just hand them the paper on this stuff because I made this commitment to do this. But they all cash flow. They have a demonstrated more than half a decade history of doing that, and they still cash flow even in this environment. But I have 2 less employees. I am the maintenance man now for 14 units. I used to have a staff, which keeps me from being able to do other things like compressed natural gas and biofuels and the kinds of things that I really want to get involved in. But all my capital is tied up in paying interest on these other properties.
That kind of relates to that a little bit. I'm just curious, without offending any of you, how many of you have your own businesses or have had your own businesses?
I'm married to a small business owner.
I hear what you're saying. I feel your pain, brother.
Oh, yeah.
It's tough for us to sit here and feel like we're on an even playing field because this is often what happens when we go into lending institutions and so forth. We're speaking to someone who's never felt that urgency that says, okay, I either give up and throw in the towel and let everybody have this, where does it go? Yeah. You've got people back out on the streets. That's your primary decision when you go to sleep at night is, do I get up in the morning and make the decision to let these families go try to figure out some place mm-hmm. to live? Or get up and do it.
Yeah, and I can't get any more out of them. I mean, they're all working another job for less money than they made before.
Right.
So the idea of being able to do things like raise the rents are certainly not an option.
And I see what you're saying, and I agree with you to a certain degree. The environment in banking has changed to the point to where banks, my employer, are holding us accountable for our daily actions. And I run my bank, not my bank, I run my office like it is my own business. I have to. I'm in complete control of my dollars at the end of the day. I have my marketing dollars just like you have. I have my limited funds to allocate for employees to be able to service my customers just like you have. I have to price my products, and believe it or not, as a national bank, and I can't speak for anybody else, I price my loans how I think I need to price them to make money. So even though at the end of the day my name isn't on that building outside, most banks these days are really starting to hold their employees' feet to the fire and saying, look, this is your business. And if you don't run it, well, you don't go out of business, you get fired, which is really kind of the same as you going out of business. Now, I'm out on the street without a job, without any income, just like you would be a kid shut down your business tomorrow.
Okay, so when I asked the question, you could have answered it that way. Because that gives you the same sense of a small business.
No, and that's why I'm answering it, because I think it's important that people understand that, granted, we're tied by certain rules and regulations that we have no control over. And you know, going back to Ed, we can't pull those 1 to 4 family residences into a commercial loan. As much as I want to help you, and I say, damn, this cash flows, and Tom's got this great credit, collateral just helps me sleep at night. It doesn't make a good loan, a bad loan good. All it does is help me sleep at night. But at the end of the day, I've still got that business to run, just like you. So I have to make prudent decisions. I actually have a lending authority. I can sign off on certain loans up to a certain dollar limit, just like most of the people at this desk can. So when I sign off on that, I'm putting my name on that. And if it goes bad, and I get a few enough of those going bad, well, it's not that I go out of business. In the case of First Community Bank, we actually did go out of business. But in my case, I get fired, so then I go out of business. So I see what you're saying, and I try to put myself in those positions. And I think any good banker should be putting him or herself in that position, saying, you know, what is this person up against? How can I help them to improve this cash flow?
Yes. I'm going to pick on Tom's example because I forgot to mention I'm also a qualifying broker and for many years was the equivalent in California. What if Tom became Tom Incorporated and Tom Incorporated's business was owning properties and now he's not a 1 to 4 owner, but he is a land company and he goes in there and seeks a blanket loan to cover all the properties at a now current rate.
But it's still considered a 1 to 4 family.
We already are.
By federal guidelines.
We already are, and we already have, and we weren't able to do it.
Because the guidelines are very clear. If I take a lien on a building that is occupied by a family, regardless, you can call it whatever you want. If a family lives there and it's a residential property, it's a 1 to 4 family residence. There's certain guidelines and restrictions in place.
Yeah.
There's HMDA and RESPA and all these other guidelines that are difficult to apply to certain commercial processes. And you can apply, kind of like Roy said, we can custom tailor these loans, but if you custom tailor it wrong, you could be in violation of the federal guidelines somewhere along the way that some regulators will come and say, don't do that, you can't do that, you're getting fined now. And you can't do that loan that way because you're dealing with 1 to 4 family residents. The other reason we don't like to deal with them is because if Tom, I'm not saying Tom would do this, if Tom decided to quit paying on those loans, then we got to go kick 14 people out of their houses. And there's other issues involved with that commercial lending is quite typically not necessarily not qualified to do, but not equipped to be able to handle those types of scenarios from a legal standpoint. So it's I'm not blaming it on the federal government because I don't like to shift blame, but we're our own worst enemy in that we allow as banks a person to come in and buy all these residences not knowing that there's really no out. This is it. There's no out for you at the end of the day. You do this loan and you're stuck here.
But aren't you concerned about getting REOs? Because if Tom walks, then first off, as I understand it in New Mexico, the eviction process for a tenant is very long and drawn out. And now you've got 14 REOs. And if the margin between what he originally borrowed is so thin and the market is flat, you're stuck with the REOs and there goes your lending capabilities because it accumulates in your capital account.
Unfortunately, residential mortgage lending, common sense doesn't come into play very often. You know, and
Well, my wife is a qualifying broker too, and then we've got some houses in Berlin in here that are 3.5 years in the mortgage process of trying to sell those houses to people. That's ridiculous. You know, they're qualified, and we all live in this kind of an environment here. We do not have a lot of people who work at high-paying tech jobs with great credit score. We have a lot of people who pay cash most of their lives, have great payment histories, have marginal credit scores, but qualify, who, even if they can scrape, like these people did, 10% down, still can't close this deal on this house. You know, and it has to do with the environment in which they're lending, because apparently Valencia County people apparently don't want to own and have liens from a banking standpoint on property here. They'd rather be in Sandoval or Bernalillo. You know, so that Our people, a lot of them are self-employed. They don't get W-2s, you know, proof of income and those kind of things is hard. It's a very difficult environment to be either a landlord or a realtor or a commercial real estate developer. David and I shared this kind of deal down here. I mean, we chose to come down and play in Berlin, you know, and
Are you saying that Tom wouldn't have the problem if he had 14 office buildings?
or if I had an apartment building
You're
with
absolutely
14
correct.
units.
You would not have that same problem. You're absolutely correct.
We just think people should live in homes.
Does that make sense?
Sure.
From a common sense standpoint, no, it
No.
doesn't make sense.
We-
But it is, I mean, it is what it is. I mean,
You know.
I can't change that. None of the other bankers at this table can change that, nor can they do anything to make that better than today.
We think people
Now,
should be living in houses and not
Is
crammed
there
into apartment
legislation that
buildings.
could be introduced at a federal level that could probably change that? Possibly. Do I know how to do that? No, I don't. I don't claim to know how to do that. I know what the current regs and rules and regs are for what I do on a daily basis, and I have to comply with those, or else I go out of business or I get fired.
Thanks.
And is it true it's like 110 new federal type regulations in the last, what is it, 6 years? I mean, I can't even imagine what you guys have to deal with, really.
And you know, I mean, I'm not a very experienced consumer lender on the mortgage side. Marina is a very experienced consumer lender. She knows more about that side than I probably will have ever known. So that's why we make sure we separate duties for one thing, because they've got a group of people that help them make sure that they stay in line on their consumer products. We've got a product now, it's called a Smart Refi, that is an incredible deal for somebody who's in a house that has under a $250,000 balance, is it? I mean, it's an incredible deal. I try to promote that product, but I don't try to sell it because I'm not qualified. So I get it to the right people.
Well, we're kind of talking about commercial.
Yeah, I think we're starting to drift a little bit, and I'd like to bring us back somehow, back into the commercial lending arena. And how can we adapt any of your questions to commercial loans? If not, we can move to kind of another subject here, but I don't know how to answer your question.
We see it is a commercial business. I mean, it was just bought with the kind of financing that made it possible to do it at the time. If there had been commercial programs that were like those residential programs, we would have done it that way.
Did you say, Tom, that you had purchased those, or you financed 100% of the purchase?
Yeah, they all belong to my wife. They're not mine, but they're all part of Fast Forward Property Development, which is.
So there was no cash down that you had to put, no kind of.
No, we always had to put something into it, and you know, closing costs and those kind of things.
Yeah.
We probably have $3,000 or $4,000, but we have some equity in them, and we bought them at the bottom of the market in '04, and they actually appreciated in value for a couple of years before all of this, you know, and they were in an area where nobody wanted to be, and we just entirely turned that whole neighborhood around because we bought most of it. And so the status quo changed, and you know, we made a real improvement there, but we're stuck right now in just a, boy, we'd like to keep moving, but it is a business, and I didn't want to get off on residential, but we would love to have it funded commercially. We just can't figure out how to do it.
And the room is quiet.
Yeah.
That's a different.
There's not a good answer for it.
No, there isn't.
There's just not. I'm sorry. There's just not a good answer.
At this
Unless
time.
somebody else in the room has some sort of magical suggestion, but I you know, got a couple over 100 years of experience sitting here.
Straightening this thing out is not going to be easy, given the status of Freddie and Fannie. I mean, they're upside down, sideways, and they're not going to come out with any. Tell me if I'm going too far off on this. I don't see Fannie and Freddie being any help in straightening out the problem. I think somehow this is going to have to be solved.
Well, in Tom's problem, that it doesn't really apply. I mean, Freddie or Fannie don't have anything to do with that type of investment purchase. I mean, like you said, it is a business.
Yeah.
What would make sense ultimately is for the lender, I mean, to realize, I mean, what's good for you is what's good for them.
Mm-hmm.
You know, if they're crippling you
We thought
financially,
that, yeah.
I mean, you know, it affects their repayment ability. But
Mm-hmm.
I mean, there are a lot of other factors that they have to consider in there. I mean, it is, you know, in most cases right now, it's a very good rental market. You know, it's precisely because people aren't qualifying, or there's a lot of rigmarole that goes into residential lending. But if yours is a profitable business on the rental side, I mean, there's a whole process that they should be looking at there. If you're able to if you're cash flowing those properties now, and if you're able to afford the note that you originally agreed to, you know, I guess I would ask, you know, what's their motivation to lower their interest rate for you?
Well, there apparently isn't any. You know, but the whole concept of these things were, you know, own them for a couple of years, refinance them once you've got a track record at a lower interest rate, which made a lot of sense.
And as you say, you're above 10% or in that
I think some of these are 10 and 12%. And they cash flowed, you know, at that number. And in a commercial business, you know, lending is only part of the expense. You know, it's when you get to the bottom line, is it red or black, you know, and they cash flowed. And all of our lenders and all of the indications were, after you've paid for 12 to 24 months on them with a perfect payment history, then you could go back and refinance them and get a better interest rate. Well, in the interim of that, this whole thing went inside out. Our asset sheet shifted from real estate as an asset to real estate as a liability, and just kind of turned our financial picture of how we look to a bank entirely upside down.
I guess, just to follow up on what you said, I mean, whenever you finance a purchase, especially an investment purchase, when you're looking at it as a business owner, when you finance 100%, I guess there's risk on both sides. I mean, there's the inherent risk that the bank takes on financing, you know, something that you have, you know, no cash or no equity in. Conversely, on your side, you're taking the risk that that property is going to appreciate. So when it doesn't, you know, you might find yourself upside down.
Or that you can refinance it.
Right, but if you truly had equity in those properties, I think you would find a lender, and I know that we would do that kind of a loan for lower than 10%. The thing is, if you truly do have equity, and in most cases, I mean, it's probably going to be 75%, you know, versus the 80 as far as the loan to value goes.
We bought them really well. They did appreciate in value, or they were worth more than that. They all appraise, even now, at 20% more than what we paid for them. But we get no credit for that 20%, and that's whether commercial or residential. I mean, that equity level.
One of them just said they put great emphasis on believing the appraisal.
Yeah. Yeah, well, the
they're required to. It's not a question.
Yeah. But now the appraisers today are ones that are brought, and this goes back to commercial and residential. The appraisers that they bring here are ones who come out of a pool, who know nothing about the local environment or the local communities, and it is impossible. You know, the comps that were used for some of these things, and we're working right now with my bank trying to even find comps. You know, trying to find commercial properties in the last couple of years in Berlin that have sold. You know, they're going to Rio Rancho and Albuquerque and these things to find numbers. And how reliable is that in a real sense?
Are any of these homes on the market by chance? Have you tried to market any of these homes?
Oh, we haven't tried to market any of these homes for some time. And the reason for it is, in this economy, we've got a whole bunch of people around us who have either been foreclosed on, or because the community was developed in 1972, are now 90 or 80 years old, and they're going into retirement homes, and their house was paid for 20 years ago, and they're just dumping them on the market.
What time do we have? I think we ought to take just about a 10 or 15 minute break, and please come up and introduce yourselves, give business cards or whatever. We'll be back in, let's say, 10 minutes, and kind of go through some more of these things and get back to commercial lending. That's all.
Okay.
Okay. Thank you.